Hi everyone, my name is Akyong, and in this video, I will share with you the 5 ways you can profit in any crypto market out there. So this video is more for those who have already started crypto investing, but they are unsure how to profit in certain crypto markets, be it bear or bull market. And I'll share with you the 5 different ways in this. As usual, the disclaimer, do pause the video and take some time to read it. So generally, cryptocurrency will profit in all markets. It doesn't matter whether it's a bull market, bear market, or sideways going, as we call it, a crab market. And they also decide their investment terms or trades based on long-term and short-term. So if you are invested into crypto, you should think and act like a whale to profit in all market conditions. So there are some points to consider in these 5 ways that I'm going to share with you. And things comes like risk and reward. So there are certain ways where the risk and the reward is a lot higher, and you have to decide whether is it difficult to execute as well. Because the more difficulty it is, it's harder to understand. It may take more time for different investors to understand, to execute the trade as well. I want to talk about time frame too, because some trades can be short-term, some trades can be long-term, and therefore you have to decide how long do you want to be invested in these different ways or strategies out there. And I rank them in a range of 1 to 5, 1 being the lowest and 5 being the highest. So before I continue, do remember to give my video a like. I do always appreciate that. Subscribe to Dr. Wealth channel for more investment related content. Okay, let's continue. So the one that I want to talk about, the first is interest earning platform. So you earn interest roughly based on 3 to 12% APR. And it's very easy to do. All you need to do is open an account, deposit crypto, and soon you will start earning interest on a daily basis. There are many platforms out there, and it's such a competitive area in the crypto space. So most of these platforms offer 0 penalty for early withdrawal, and some even offers 0 withdrawal fees. So you're able to deposit and withdraw without incurring any gas or transaction fees. But the thing here is this, interest earning platforms, because they are very easy to set up, you're just transferring your coins in, it's actually very low risk and therefore gives you a very low reward, because the only risk that you are taking on is either the coins value that's fluctuating and the platform turning under or going bust. This is pretty much 2 of it. Because as usual, any coins that you do not have control, you do not have access to them. So the first one I'm talking about in the interest earning platform is Nexo. Nexo has been around in the business for many years, and they offer a lot of coins out there, not just the basic stable coins. Last I remember when I first used them, they have about 20 odd coins. I think today they close at 40 to 50 different coins. And one of the interesting part about Nexo is that you can actually earn interest in their native coin, Nexo. Nexo. So what I mean by this? In an example, I would say if you are depositing Ripple XRP into the platform itself, you could be earning 10% on your deposits. But if you collect your rewards in Nexo coin, you could be earning at 12% instead. So that is the difference. In a way, you must have conviction in the coin itself. Another platform pretty much like Nexo, and I've covered it before in one of my past videos, is Celsius. So you can also do it the same as Nexo. You can deposit your coins, earn a higher interest by earning Celsius coins or CEL. And I would say both platforms are pretty competitive. They're pretty similar. But the thing you have to understand is this. When you're earning coins on the native platform, yes, you are earning a higher interest. You're earning, instead of 10%, you're earning 12%. But take note, if the original coin goes up by 10% and the native coin goes down by 10%, your interest that you're earning, it actually loses in value. So always take that in mind. But if you are holding more stable coins, or the big two, as I call it, Bitcoin and Ethereum, the next one might be more interested for you. Hodlnaut. Hodlnaut is one of Singapore's company. They launched in Singapore, I think, about 4 or 5 years ago. And they have been around to provide interest-bearing platforms and deposits for their members during a period of time. So they don't hold a lot of coins. All they cover is the big two, USDC, USDT, DAI, and I think they're bringing up more stable coins soon if there is market for them. Generally, all these platforms, what they do is this: they act like the bank in a way. So they get the liquidity from you guys as depositors, and then they lend it out to leverage traders who are lending usually stable coins to either short the market or to do a leverage trade in their positions. So I rank interest earning platforms a risk of level 2 or 2 points, because I don't think there's a lot of risk out there compared to just the coin fluctuation in value and the platform itself. Therefore, the rewards are usually a lot lower, about between 3 to 10%, or some will go up as high as 12%. This is very easy to do because you just need to open an account and deposit. That's it. And you can deposit as long as you want, depending on how long you tend to keep the coins on the platform itself. So you may say that this is quite low, quite high interest, earning 10 to 12%, but in the crypto markets, this is considered the minimum or the lowest end of the interest. Why? Because in the next few ways that I'm going to share with you, some of them can be earning between 50, 70 to almost 100% on interest on the coins, and the ways you can actually grow your own portfolio. So the next one I'm going to share with you is called options trading or technical analysis. I put them together because they both need a certain set of skill sets to understand the market. They need to understand the market movements based on the charts. You need to have the skills to do this sort of trades. You need to learn from experienced traders, or learn from trainers, because you can watch this being done on YouTube, or you can learn this on your own. But it can be a bit painful because you have no one to guide you. And let's say if you make a mistake, you are unsure how to correct them as well. So classify them usually as a mid to high risk. Also same for the rewards, because I have seen traders who have made 2x, 3x based on the 2-hour time frame trade that they are doing. And the best of all is this: you can do leverage trade on most of these platforms, but do understand, every time you do a leverage trade in crypto, you multiply your own risk as well as your own rewards. So it may look nice, you may earn a lot, but do understand the risk as well. So some of the options trading platforms out there, Deribit, QDEX, Delta Exchange. And do take note, when you're on these platforms on options trading, always take note of the volume, because you don't want to get into a platform where they have high premiums that you can sell or you can collect, and yet there is not enough volume to collect the interest or collect when you want to buy or you want to sell, to close off those contracts. Same goes for technical analysis. You can do it on most centralized exchanges. Some of these platforms even open up trading accounts for traders, and they offer them at the lower trade fees instead of normal investors who just need to do spot trades. Also, at the same, I will always recommend getting a high volume exchange, such a way that you can actually trade and exit when you need to, based on the time frame itself. So in a quick summary, I will put them as a risk of 3 to 5. Same goes for the rewards, 3 to 5. But I will rank this a lot higher in the difficulty manner, because you have to learn how to execute these trades properly, safely. And if you're doing in leverage, the risk and rewards is going to increase exponentially as well. As for time frame, I would say it's up to the trader's decision. You can decide if you want to do a contract in a daily, in a weekly, or in a monthly method for options, or you can decide your own time frame or how long you want to enter and exit the market in a technical analysis trades. So the next one, I'm going to lump the 2 points together, which is yield farming and staking. So there is a little bit difference here. Yield farming is where you put up 2 different assets and you provide liquidity on the platform and you earn a certain yield from it. While staking is you take a coin and stake it on a platform to earn the interest rates from the platform that's giving you those interests. So the interest range between 19%, which is one that I'm going to share with you later, up to almost 700, 800%, which are some of the platforms that are rather safe, still risky, but safe, that I would put a lot of money into it. Range from being $10,000 to $20,000, and these are certain platforms I will put in. But there are some platforms that offer insane APY, like 1,000, 2,000, or 5,000 platform, 5,000 in interest. But you have to understand as well, some of these platforms, because it's high yield, it becomes high risk, because you have to understand the financial terms and the technology behind yield farming. These platforms, some of them may be scams, they may be honeypot scams, they may be rug pulls, and you may never know who these developers are. So unless you have very high trust and you have done your own research, you are experimenting with a little bit of money, making sure that you are getting the gains, and you do know what you are doing, then you can earn this type of interest on cryptocurrency yield farming and staking. So I'm going to share with you one example, and I'm pretty sure this is quite popular right now. In the past 3 to 4 months, many people are staking their UST, which is actually a USD stablecoin, onto the Anchor protocol to earn 19% minimum interest on their coins. So can you imagine kind of like putting US dollar into a fixed D, and you can never earn this kind of value or this kind of interest rates, because Anchor protocol is acting pretty much like a bank or a lender's platform. So what you do is that they take your money and then they lend it out to leverage traders. And what they do is that they take that tiny difference and they give you the rest. So what they are lending out to other leverage traders could be at 21, 22%. They pocket about 2 to 3%, and the rest goes to you. So this is what I mean by high yield staking. And then there are many platforms out there that you can actually stake all these coins as well. This is just one example. And if you want to give it a try, you must always learn how to do it, find out more about Anchor protocol. And if you ask me if it's safe, I can say that it's fairly safe. On the Anchor protocol that I recently just checked, there's close to be about 8.5 billion that's staked on the platform itself. So there's a lot of money on this platform. And imagine if someone actually runs away with this sum of money, it's going to be a lot of broken hearts and a lot of empty wallets out there. So next, I'm going to talk about yield farming, and they usually come in pairs. So when you do yield farming, you have to understand what is liquidity provision, what is liquidity pools, and where can you find all these liquidity platforms that you want to stake your coins in. You also have to understand what is impermanent loss, because when both sides of the coin start to increase or decrease in value, you have to decide whether are you earning, or are you making a profit, or are you making a loss, because you have 2 assets that's being paired. As you can see here, some of these pairs can earn you very high interest, like 8,000, 1,750 over here, but those are very exotic pairs or on platforms that are not very well known. As you can see here, HDRN and USDC pairing is earning you 1,750%, but the total value locked on the platform is only $90,000, which is just a very small amount sharing that emissions pie. Another analogy that I can give you is this. On liquidity platforms, right? Imagine it's a bakery that's always giving out 20 cakes a day. And let's say there's 10 of you sharing that 20 cakes. Each one will go back home with 2 full cakes. People find out there's free cake. They all come in. And now you have 20 people who are sharing 20 free cakes. So now your emissions have reduced, or rewards that you get reduced from 2 cakes to 1 cake. The following few days, there's more people coming in to grab all the free cakes. Your cake share becomes smaller and smaller and smaller. Therefore, the APY is not fixed. It can range and can fluctuate based on how many people are staked on the platform, how much money is being shared among the stakers in that pool itself. So high yield farming and staking are very rewarding, but they do come with their own apparent risk because you never know when you're getting a scam or you're going to get rug pulled by developers. In my experience, 9 out of 10 DeFi projects out there are usually cash grabs. What they do is that they tempt greedy people to stake, to put the coins on their platform to earn their high insane APY. And at any point of time, these platforms can disappear, and all your coins will just be lost to the developer as well. So I usually rate this as a 4 to a high of 6 risk, because you have to understand it's a very high risk. Anytime you could lose all your money when you are staking on these platforms. But if you know what you're doing and you understand the risk, you're able to earn a very high rewards as well. Remember, I talked about the number of cakes that you can get per day. Imagine if you're early to a bakery that's giving out 20 cakes and there's only 5% out there. It means that you're getting 4 full cakes a day. So some of this capital that moves around yield farming, that's what we call a mercenary capital. They will only go to platforms to earn those high interest, pull out when the interest becomes lower, and go to the next one. So they'll always be jumping around it. But it's quite difficult to enter all this yield farming unless you know the know-how of the certain tools and how to read Etherscan, how to talk to developers who are coming up with new DeFi platforms, how to get into these communities, how to use the tools such as MetaMask and your Ether wallets, your hardware wallets for security basis. You have to understand all these things. And if you do not know any of this, it's going to be very difficult for you to participate in yield farming or staking. For the time frame, it can be ranged from days to months. I have done before kind of like the mercenary capital in a way. I put it 10,000 in a certain platform. I earn about 500% APY in per annum. I took out $1,000, about 1,200, and I'm happy with it. I pull out because I know that the platform is a bit risky and I cannot trust the developers. So I took out 10% profits. I'm happy with it. I move on to another platform to be more stable and the other platforms that are better in this case. So I've talked about 4 different types already: options trading and technical analysis. I talked about interest earning platforms, yield farming, staking, and the 5th one I'm going to share with you is cryptocurrency mining. It's one of the earliest, if not the first ways on how we can earn crypto in any market conditions. But the difference is this: we started off cryptocurrency mining with just proof of work, but they are coming up with new methods and using less hardware, less reliant on hardware and energy resources into what we call a proof of stake. So the proof of work or proof of stake mining depends on the developers, on how they code the system. Like Bitcoin will still remain as proof of work, but they are considering to move over to the proof of stake. For Ethereum started off with a proof of work, but by June 2022 this year, they're going to shift everybody over to the proof of stake. So they announced this in late December 2021, and they give all the miners 6 months to transit over to the new model. So proof of work is slowly getting unfavorable, and a lot of new coins are slowly phasing them out because it costs too much just to farm on the coin itself, and the hardware costs, the electricity costs, the geographical and political challenges that they face are all coming in to challenge the network itself. And not only that, as a cryptocurrency miner, you have to come up with very high capital. No longer can you just buy 1 or 2 end miner machines and mine Bitcoin at home. Now they are big players, and I'm going to show you a photo later on how big a mining farm can be. So as mentioned, you need to be high capital, and you look at this, the latest machine or end miner to mine Bitcoin costs ranging from $10,000 to $17,000. And you need to have a high hash power rate, because the higher hash power rate, the faster you're able to do transactions, to verify transactions, the more Bitcoin transactions you're able to collect. At the same time, every day there's new Bitcoin being released out to the market. If you're the first one to solve the problem, the hash, then you'll be able to reward back the Bitcoin as well. Imagine right now the rewards is 3.25 Bitcoin per day. If you can get at least 10 out of 30 of the on the month, which comes out to about almost 30 over Bitcoin at the price of $40,000, that is close to be about 120,000 USD. So this is what I mean by you need high capital to farm or mine Bitcoin. And when I say big players, I mean big players like this. This is called a mining farm. So each machine you see sits on a rack, and you have like 50 or 100 of these machines are on this rack itself, and you have multiple of this rack. It's going to be called farm. So all these farms can be set up anywhere across the world. It can be in China, Finland, Sweden, Kazakhstan, US, Japan. It doesn't matter. All you need is electricity, ventilation to cool the machines, and internet connection. That's all you need. So when we talk about pollution, especially this having a very bad name to them, you also have to understand that the electricity that's being used to power up all these mining rigs, you can put it up in, let's say in Finland, where they're using hydropower, and it's generally very cold climate out there. Therefore, they just need to ventilate the place to make sure that the machines are cooled, naturally cooled. And the cost of the place can be very cheap because they are placing these machines way up in rural areas like the mountains or way out of the city limits. So all these costs can be very cheap. But let's say if you are in a place like Kazakhstan, where the country is warm and electricity is expensive, and they only use coal power, and you need large fans or even air conditioning to cool all these machines, the cost rakes up. And based on the amount of Bitcoin that you can mine versus the cost itself, sometimes there isn't much profit at the end of the day. So this is one of the considerations of cryptocurrency miners. But for you and I who are retail investors, we won't be getting into such place as well, because there's really no almost out of reach for us. I mean, you're putting in close to millions of dollars, and you must have the connection to be able to set up all these places, to hire the people to maintain all the machines as well. So it doesn't work out as well if you want to buy one or two machines either. So my suggestion is that if you want to enter into cryptocurrency mining, just invest into listed companies in the US or in many other countries where they're operating Bitcoin mining farms. In this case, whatever profits that they earn, you are earning as well. They have a share of the profit. So this is how I feel, and I think that you can get involved or get exposed to cryptocurrency mining. But that is for proof of work. How about proof of stake? Proof of stake runs on the master nodes and things like that, are nodes that is situated on a server, and these servers can be sitting in a data center connected to the internet. And these data centers can serve for many other purposes, such as file sharing, video hosting, business meetings, things like that. So you're not running a hardware machine purely just for mining crypto. It can be doing other things as well. Therefore, it's a lot more safer. It's a lot using less energy, and at the same time, usually the cost is a lot lower sometimes, in a way, because some of the costs that you need to pay off is definitely the server subscription, but you also will have to come up with at least a minimum amount of coins to set up the master node. If you want to try your hand on proof of stake mining, you have to understand how to do a programming on the network itself. You have to do a know-how, you have to chat with people, you have to talk to developers, and some of them even have the minimum amount that you need to stake, or you need to buy the coins to stake, and a time frame where you are unable to remove out, because they want your node to be up and online or 24/7 for a fixed amount of time. It can range from 6 months to 2 years or 5 years, depending on the developer's decision. And this, you put yourself at the mercy of the coin's value, because you could be earning a very high interest rate, but if the coin's values keep on dropping, then you're actually not earning a lot in dollar cost value. So I took this chart from staking rewards, and you can see that these are some of the high yield or high rewards masternode staking. As you can see here, some of them are offering 140%, 62%, 55% for even for DeFi coin, 51%. So as I mentioned, some of them needs to lock up and things like that. And let's take a look at one of the coins. How much you want to put in, how much you need to buy the coins, and how long you need to lock the coins up as well. So I'm going to use the example of DeFi coin or DFI. So as you can see here, to run a masternode at the bottom, you minimum need 20,000 coins. And the price of DeFi coins is at $3.72, which means that just before you even do programming to buy a server service which can host a node online 24/7, you already need to pay $74,000 just to buy out the coins. And that doesn't include the service cost. So these are additional costs on your end. You can still earn a decent rate. I mean, the rewards here, they're earning between 35% to 60%, which is pretty good for this. And there is no lockup period as well. So this is something that some of cryptocurrency miners may consider to do. So cryptocurrency mining, I'll put the risk 3 to 5. The rewards also 3 to 5 as well, because you are running on the risk of not just a hardware always be improving. You're also running risks such as, you have to understand the know-how, the coin fluctuation, and it's also a lot of high capital outlay as well. I mean, you can buy a coin for only $50, but when you want to do a masternode or you want to do mining, minimum you need between $70,000 to $100,000, and it's only for one single coin. You cannot separate out to 10 different coins or diversify your portfolio to different coins as well. Therefore, I say this difficulty is 3 to 5, and you must understand what are the challenges that you face when you're doing cryptocurrency mining. For time frame, usually I would say between 6 months to 2 years, because if you do it in a short-term period, within 1 month or 2 months, you won't be able to recover any of this interest, or you won't be able to earn, because the cost of starting up is a lot higher as well. So in summary, there are many ways to profit in the current crypto space. You can do many of these ways that I shared, whether it be interest earning, mining, yield farming, and just try your hands on any of them. And I've not even touched on the emerging sector of NFTs and how they can be part of your portfolio as well, on how you can earn interest by lending out your NFTs or getting into projects and waiting for the value of NFTs to go up, buying them at low. So there are many ways to profit in the crypto market space, but you have to understand your own risk appetite, how much capital that you have, and what are the rewards that's out there. So you have to understand this risk and how to maximize the rewards you can get from the capital that you have. How much effort you're going to put into it, and how long are you going to do it as well. So all these things comes into play as part of the factors of becoming a whale in the crypto space. And as I mentioned at the start, crypto whales usually use more than just one method out there to profit in the crypto markets. Personally, myself, I use interest earning platforms. I do options trading, I do yield farming, I do staking, and I've done a bit of cryptocurrency mining before, but I realized that it's too high capital, and I don't like that my coins are all stuck in a single asset as well. So this is generally my position, and I do hope that if you are watching this video, do consider about your own cryptocurrency portfolio and how you can earn in different market conditions. So before I end off in this video, I do appreciate if you drop us a like on this video itself, and you have not subscribed to the Dr. Wealth channel, so please click on the button and subscribe to Dr. Wealth channel to enjoy more investment related content. And last of all, if you do and want to let your friends enjoy this video as well, do share with them and let them know more about the fun and exciting places that can profit in cryptocurrency investing. I'll see you guys in the next video.